Hello, hello. We are live. Welcome to everybody to the Sullivan Group Market Huddle. This month, so June, we are going to be talking about mastering buying before you sell. So we have talked a lot about this. Every mortgage lender out there talks about buying before selling like constantly. I'm sure you guys are getting tired of hearing about it. But did you know that our market is one of the markets that uses this tool the most out of the entire United States? Here in the Bay Area, we all know that in order to sell a great product, we need to have an empty house. The house needs to be ready for you guys to come in and put your finishing touches on it and put this wonderful product together that the consumers in the Bay Area are used to seeing. They want to see the finishes, they want to see the shiny new paints. They do not want to see the kids' sneakers in the bedroom or the laundry basket that's sitting there with the old dirty clothes. Buyers do not want to see that people actually live in these houses that you're trying to sell. So, what better way to make sure the house is ready to go and gets the highest price than getting your clients into their right home before they sell their old home? So, we're going to go ahead and kick that off. I'd like to introduce my wonderful husband, Casey Sullivan. You guys all know who he is. He's been in the business for over 23 years, and I listen to him all day long talking to clients, and he knows what he's talking about. So I'm going to bring on Casey to get us started. I know we've got only 30 minutes, and we want to use your time wisely because we know that in real estate, every second counts. So in a second here, oh, there he is. Here is my husband, Casey Sullivan. I'll let you kick it off, Case.
Well, that was a good introduction. Thank you. So let's just get started. Since we have 30 minutes, let's see how far we can get into this. And there will be a survey that'll pop up at the end. So it's always helpful if you could fill that out to help us figure out the great topics for the next upcoming webinars. And this webinar is recorded, so it will be emailed out to you. So in case you need to watch it again, or there was a part you have to go back and check on, you will get a recording. The chat is definitely open in this, so don't hesitate to chat. You can say hi, you can ask questions. We are monitoring that throughout this webinar. And if you send a chat at the very end, we'll still see it, and we can reach out afterwards and make sure we answer your question. And we always have some resources on our Linktree, which you can easily find on our Instagram page, which is at the.sullivan.group. So make sure you follow us and always have access to additional resources. So let's get going with an introduction. So I work for a company called Cross Country Mortgage, and the stats that we got from them from the national level in the last couple of weeks is we are again the #1 retail mortgage lender in America, and we're the #1 non-QM, or what I like to call portfolio lender in America as well. So we just don't advertise at the Super Bowl or on TV, but we're awfully large across the country here. I run a branch, the Sullivan Group, and my team involves me. I'm a loan officer and a branch manager. My wife, who you met a couple seconds ago, she does our business development and realtor support. We have our ops manager, Nicole Garcia, and we have our marketing coordinator, Melissa. At my branch, we also have 2 additional loan officers, including one that only specializes in reverse mortgages. And then we have all those other people in the mortgage business, processing, underwriting. We do lend in all 50 states, including Puerto Rico, and we are always hiring. So if you ever are out talking to a loan officer that's not happy with where they are, I would love an introduction. Or if you know of a mortgage support person or a salesperson that is looking for a job and they're just dynamic individuals, send them my way as well. So let's get started with the topic of the day, and it is buy before you sell. So what is buy before you sell? Well, we define it as financing options to help clients buy a new house before selling the current one. Pretty simple. Now, there are many ways to accomplish this. As a lender and a broker, and in the Bay Area, I've spent a lot of my time building a strong portfolio of these buy before you sell options to help our clients. What I tell some clients is if you talk to a friend who's in Kansas or Texas, they don't even know what this is. because that's not their typical market. But in our market, it's a little different. These buy before you sell products, they really address the common challenge of timing the two transactions, which, on the real estate side, can be quite complex. Now, why clients love buy before you sell? Well, we know their offer is going to be stronger because it'll be non-contingent. So that alone is number one reason that people would, choose this. They obviously get to negotiate from a position of power. So they get to then also have more time to find the right home. So they're not feeling rushed if they have their house under contract and are doing a contingent offer. I like to call this the sell efficiently. This is where you move out of your house into the new house, and then you can empty out your house. You can fix it. You can do any rehab that's needed. You can stage it and then hopefully sell it for more money. It obviously reduces stress of all the moves. So it avoids the double moves and the temporary housing. And it definitely, some of these products allow for smoother transitions, and it might be a career transition, like a new job or retirement, family or life moves. So those are some of the main kind of things that we hear that clients love about this option. Now, what clients worry about this option is some of the products would have a double mortgage, so they're paying two mortgages for a short amount of time. We hear also, hey, my equity is all tied up into two properties. They may feel some pressure to sell on some of the solutions. Maybe they have to sell it in 4 months. Some don't require that. There can be higher costs or just complexity of understanding the differences of mortgage products. And then there's always the market risk. So if they own two houses and they're trying to sell one of them, like what about if values change in their neighborhood? So those are kind of the pluses and minuses that we hear a lot about. The key strategy. So I always think that we've got 11 ways to help somebody buy before you sell. And there's probably more than 11, but that's kind of where I start with. So we're going to briefly review a couple of them, and then we're going to go deeper into the most popular to help you when you're talking to your clients. Kind of on the brief level, one common one is, maybe somebody has enough equity if they sold their house to put down 20 or 30%, but they just have maybe 5% right now. So we'll do a 5% loan now. And then after they sell their house, they could then take that extra money they got from the sale proceeds and send it in, and we'll do a recast. And what a recast is normally when you send in a big chunk of money into your mortgage company, they see it as a principal reduction. We happily take it, but your mortgage payment doesn't change. But with a recast, you send in the money, and then we will reset the payment based upon your new balance. So it gets them the payment that they would have wanted initially by doing the recast. So that's an interesting option. There's a couple things that we see marketed out there. We offer products like backup cash offers or guaranteed backup contracts. These are a little gimmicky, but basically they do certain things where they'll give you a contract to say, we'll buy your house from you, and it will just be this big company that will buy the house from you, and then it allows us to help them buy the next house, knowing that they have an offer that can close on that house. Or if it doesn't close, that company will then buy your house. You may have heard of some companies like Fly Homes or Home Light, companies like that. So we have all of those products. They definitely require a lot of consulting with the client and the realtor so that everybody understands how they work, but those products are out there. And then there's delayed financing. This is when a buyer has just a pile of money, or they have a family member who's willing to give them some money for a time being, and they can buy the house in cash, and then they can come back afterwards and put a mortgage on the property to pull the money back out to either pay themselves back or pay off a family member. And the value of delayed financing is if it's done right away, the IRS sees it as purchase money, which means it falls under the ability to write off the interest. Because if you wait too long after you pay cash for a house, it no longer follows under the purchase money rules. It falls under the cash out rules. So this is a tax efficient way of doing it. Now let's look at the most popular ones. The most popular is renting out the departing house to offset the payment. The next most popular is what I call the cash boost bridge. So it's a bridge loan. Another one is to take a HELOC out on the house. Again, I'm going to go into these in greater detail. The next one is a portfolio loan with an optional bridge. And the last one is the golden bridge. Do not confuse that with the Golden Gate Bridge. It's the golden bridge. And as we jump into these, if you think about the first one is renting the departing house. So this is pretty common, doesn't require a lot of complexity. This is where a buyer can use future rental income to help offset the mortgage payment. And what happens is before closing, so before they close on their new house, we need a rental agreement and an appraiser's rental survey to support that rent to use it to offset it. Now, we can do this even with no history of owning rental property. We can still use 75% of the rent that's on the rental agreement or the rental survey, whatever is lower. And the 75% is to assume that there's a 25% expense factor, vacancy factor in there. So again, we can use 75% of the fair market rent of the house to help offset the mortgage payment. Now, the biggest question clients have about this is, well, how would I rent it and move the tenant in when I'm still living here? So the rental agreement can have occupancy by the tenant that occurs after you move out of the house. It can be as delayed as about 30 to 55 days after closing on the new house. You have to have the tenant in the house, and we would give the exact date. It depends upon when and the time of the month the buyer's closing. I can tell them when they need to have the occupancy in there. So it gives you time to rent it, then close on your house, move out, and have the tenant occupied. Now, in some scenarios, very few scenarios, we would ask for proof that the tenant paid that first payment and security deposit if they're renting to a family member, meaning the contract says, the same last name, for example. But in most cases, it's just the rental agreement and, again, the rental survey. So I can just think through my pipeline now of people buying. We have 2 people using this right now where there are, we're using this future rental income just to make their qualifying work, because we're basically qualifying them to own 2 houses at the same time. So this is an easy one. It's not a different loan. There's no bridge loan in here. It's just a simple way of documenting it to get them a little bit more income. Another one is called the Cash Boost Bridge. So bridge loans come in many different styles and types. What this one does is it uses the equity from the client's current home only to buy the next home. So it's a way to suck equity out of their current house to use for the down payment on the new one. This is a great option when the buyer doesn't have time to add a line of credit or a second mortgage to their house. So it can be done at the same time as purchasing the new house. So it can all be done together. On this loan, it generally goes up to $700,000 is how much you can pull out, and up to what we call 85% combined loan to value on the current home, which means their current mortgages plus the bridge loan can't exceed 85% of the home's value. So it lets you take out a good portion, just not 100% of the equity out of the house. There is no prepayment or early payoff penalty on these. There's no payments on them. They're deferred. There is a 4-month term, meaning you have to pay it off in 4 months, which means you have to sell your house. There are some extensions available in case you need some extra time, so we do have that built into it. The expected rate is 9.25%. It's fixed for those 4 months. And the expected points is usually about 1%, but some of the programs offer rebates since it's just a short-term loan. So that is your traditional bridge that's just taking money out of one house to help you get the down payment for the next one. So it works. It's not the most common bridge that we see in higher cost areas, but it is an option for certain clients. And then we're following it up with a HELOC, or what we call a line of credit. So again, this is a similar scenario. This is using equity from their current home to buy the next home, right? So this is somebody who can qualify to own 2 houses at the same time, but that just doesn't have the down payment. So that would be the same with the bridge loan or this HELOC. Is they can swing owning 2 homes, but they just have all their money tied up in their home, or maybe they have it in investments that they don't want to liquidate. So this is where the HELOC can come in. This really works best when there's time allowed to get it set up before making an offer, because we don't want to have you write a contract for a buyer that says, hey, I'll buy this house, but it's contingent upon me getting a line of credit against my other house. So when it comes to proof of funds time, it's not very easy to show, a pre-approval on a HELOC to do that. So we really like them to have this set up before they write offers, so that all they have to do is just take a draw from their HELOC. Now this loan, again, it works up to $700,000, $750,000 is usually where we see them tap out at. And again, it goes up to 90% total loan to value on the current home. So again, the line of credit plus the current mortgage can't exceed 90% of what the home is worth. There is no prepayment penalty, no early payoff, so there's no penalty there. There are interest-only payments on the amount that they utilize. So the amount they utilize, so it may start out where they take out a $500,000 HELOC, but they don't pull any money on it yet, because they're just out home shopping. So there's no payment. Then once they pull the money, either for the EMD or for the down payment to close, then that's where the interest payments start, and they continue until the loan is paid off when the home is sold. Now, this loan does require full credit qualification, meaning we're looking at income, debts, credit scores, things like that. These HELOCs are the only real mortgage that's driven by the prime rate, which is what the Fed actually controls. So if we look at what an expected rate is, it's always we're going to start with the prime. So, today at 7.5%, if you're watching this later, verify what it is at the time of watching this video. But prime is 7.5, and then we could add something to it. And the add is, based upon somebody's credit score and how much they're borrowing against the house. So it's kind of starting around that mid sevens and could go up. So that's what a HELOC would be. And this is where they get access to money for the down payment and closing costs. Now we're going to get a little bit more exotic. So this is called the Golden Bridge Loan. To me, this is the loan that we get the end of the day when somebody's really looking for a bridge loan. This is where we end up with most situations. It's the most complex of the situations, so bear with me here. So we're going to use equity. This loan uses the equity to buy the next home with a cross-collateralization bridge, which we'll talk about in a second. But basically, this bridge loan is going to be applied to both their current house and the new house. And it allows for up to 100% financing. All the buyer needs is their EMD and closing costs. So that at least has to be somehow available in savings. But the loan itself can be 100% financing. The calculations, which we're going to go over, is 65 to 75% of lending we can lend against both properties combined. Very important, there's no prepayment penalty or early payoff penalty on our bridge loans. Some bridge loans out there do have those. We do not, so that's an important feature. The most common is we just use automated valuations for the homes. In most cases, it's pretty rare that we send an appraiser out. Some of our products may be require an appraisal, but most of it's just an automated valuation. So it makes it pretty fast and easy on that side. Most of them have terms of 11 to 12 months, so meaning the buyer has 11 to 12 months to sell the house and pay off the bridge loan. Now, they don't have to take that long. I've never had anybody take that long. Usually they pay them off in 60 to 90 days. But if you had somebody that had a unique situation where they wanted to buy the new house and then they were going to do a big remodel on either of the homes, so they weren't able to complete the transaction completely right away, that could be a time where you may use it. We had one client who bought a new house right around Thanksgiving, and they didn't want to then list their departing house in the holiday season. So they ended up keeping the second home, or the old home, through the holidays and into January, February before they hit the market. So they used their bridge loan a little bit longer, but it was very strategic. So they had to pay the interest cost over that time, but they definitely made up for it by selling at the right time. These bridge loans do allow you to buy up to $10 million. So in case you have a $10 million buyer, you're good there. The payment is interest-only payments on the balance. With some of our bridge loans, there are some possible deferral in there. I find most clients like to make the interest-only payments because it keeps the payoff at the end lower. But there are some possible deferrals. It usually comes down to clients that are just tight on money. So we'll end up talking them through that and figuring out if this is even the best option for them. And if they really want the deferral, we'll use that product. Now, the expected rate on these, they're high, but again, it's a temporary loan. This is not a long-term loan. We usually find the rates in the high 9s to high 10s right now. It is a fixed rate mortgage. So if it's definitely higher than what you would get on a traditional full dot conventional loan. and hopefully you only keep it for 60 to 90 days. There are points that go along with it, which is the cost with the loan. It's usually 2 to 2.5% for most of them. We only income qualify somebody, so we only do your traditional, what we think of a pre-approval or underwriting, if they need a loan at the end, which means like if they're going to do this whole transaction and they're going to have enough equity from the house they're going to sell to pay off the bridge loan, and they're not going to have a loan, going forward, then we're not looking at their income. Only if we need to worry about a final loan. So that means no job is okay. Most of our clients end up using these loans and don't get a loan at the end. And so therefore, we're not worried about their income qualification. Now, this loan, one of our options does allow the ability to overfund it, which means we can lend more than what the purchase price of the home is in case they need money to do projects. Now, how we calculate it, I'm going to go into detail on the next slide a little bit more, but we basically add up the value of their current house and the new house. And then we can use 65 to 75% of that. And then we have to subtract any sort of mortgage they have on their current house, and that's the bridge loan amount. So let's look at an example. So let's look at the one on the left. So this is no ending mortgage. So their new house is going to be $1 million. Their current house is $1.5 million. So we have downsizing here. So their total property value is $2.5 million. Now we'll use the loan we use most of the time, which is 75%. So the maximum loan we can issue is a 1.875 mortgage. Now, let's say they already have a mortgage on their current house of $350,000. That means our max loan can be 1.525. So we can lend a little bit more than 1.5 million. Now they're looking to buy a house for 1 million. So that means we can lend 100% of the $1 million. So we can give them a $1 million bridge loan. Now, when they sell their house, we expect, that maybe they'll get about $1.075 million. They start with $1.5 million house. They have to pay the real estate agent, compensation. They have to pay off their $350,000 mortgage. So they're going to get enough from the sale of their home in order to cover the full bridge loan. So in this transaction, when the dust settles, they bought their house, they sold their other house, they're going to be mortgage free. Now, if they prefer to have a mortgage, for financial reasons, we can still give them a mortgage at the end, but in this case, they can be mortgage free going forward. Now, the one on the right-hand side, I'm going to turn off my camera so I don't cover that up. But on this one here, it says the ending mortgage, this one has an ending mortgage. So let's say they want to upsize. So we still have $1 million house that they currently own, but they want to buy a $2 million home. So now we have total property values between both homes of $3 million. Again, we're going to use the same 75%, so we can give them a loan of $2.25 million. Now, they still have that same outstanding $350,000 mortgage on their current house. So the maximum loan we can give is $1.9 million. So that means that we're a little short because they wanted to buy a $2 million house. So in this case, it requires a $100,000 down payment. So they have to bring $100,000 in, and I can give them $1.9 million mortgage on their $2 million house. Now they're going to sell their $1 million house, and again, they're gonna net some money, but it's going to be short a little bit. So they're going to need a refinance at the end. So I call that a takeout loan, kind of like a construction loan. So it comes at the end. They buy the new house, they move into it, they prep and sell their current house or their old house. Then they pay off as much as they can of the bridge loan, and then we give them a new loan to make up the difference. So these are kind of the two scenarios that we see is, does somebody want a mortgage at the end? So usually if somebody's retiring and downsizing, usually they say, no, thank you. Now, if they're moving up or moving to a more expensive neighborhood, they may end up with a mortgage at the end, and we can do it either way. But really what the key is here is 100% financing in most cases is what we see. It requires them not to sell their house or to be contingent. It allows them not to have to deal with underwriting in the same way. So usually you have very clean offers that don't have the contingencies that you would normally expect. It's just a smooth process without having to double move. So that, again, that's the most common request we get when we get into the bridge world of somebody buying before you sell. If somebody has money and they can qualify to own two houses, we don't need to use tools like this, but this is the most common one. So let's turn my camera back on and let's go to the next slide. So this one is a little different. This is called a portfolio loan with an optional bridge or HELOC. So now this is for buyers that can't qualify for 2 home payments. So they want to buy another house. We look at their income and their debts, and they just can't do it. They can't swing both homes at the same time. So what this program does is it ignores the mortgage payment, which lenders like to call PITI, which is principal, interest, taxes, and insurance, and HOA dues if there were. It ignores that on the departing home. So we only are looking at the new housing expense. We're not worried about whatever housing expense occurs on their house. Now they do have to send in either a listing agreement or a little letter saying they intend to list the house in 90 days. So showing their intent that this isn't a house they're going to keep. These do have pretty much traditional loan products, your 30-year fixed, your adjustables, your traditional loans. You would expect in most cases that they're going to have higher rates or points just because of the flexibility. Now, if the buyer happens to need this program but is also short on money, we can add a HELOC or that cash boost bridge to it and ignore the payment. So think about client comes in, they don't qualify for both homes at the same time, nor do they have any money. So if they've got equity in their house, we can put on a HELOC or a bridge on their current house. And then we get to ignore their payment for both mortgages, their current mortgage, this HELOC or bridge that we give them, plus the taxes and insurance, so that we can just focus on the new house. So a scenario of somebody that came in is they wanted to buy a $1.8 million house. Their current house was valued about 1.4, he thought, and he owed $650,000 on the mortgage. Now, his income did not support owning these 2 homes, and he didn't have the down payment. He only had enough liquid assets to cover the EMD, thankfully. And we couldn't do a golden bridge because the loan to value was greater than 75%. So the solution was we did a bridge loan for $400,000 to cover the down payment, the closing costs, the moving expenses against his current house. And then we did this loan on the new house. And, he's going to move into the new house, or maybe he already has, and then he will pay off the bridge loan and move on with his life. So those are kind of the options that we see out there. Probably the easiest way to hand off a buy before you sell buyer to us in 10 seconds or less is to say something along the lines of, my lending partner has 11 strategies to help you buy before you sell. He'll review your goals and finances to suggest the best course of action. Okay, if I connect you? Something along that line is all that it probably takes for me to have that conversation. Anytime I'm having a conversation with somebody on the phone, on Zoom, in person, we're not jumping into running credit or that. We're talking more about strategies. Okay, where are you now? What are you looking to do? Kind of an overall financial picture so I can start to figure out, is this something we can accomplish, with more conventional products? So we're looking at the portfolio loan. Do they need to pull money out of a house, or are we looking at the golden bridge? So that's where I come in, and then I will report back to you as to kind of what the path is there. And if you're interested in, getting more information on this, maybe co-hosting a buy before you sell webinar, or you want some custom flyers about some of these strategies that you can send to your database, let's collaborate. Happy to get you information or help on that. And if you want to shoot a video on this, I can get you a video script, or if you want to put this in a newsletter or as a social media post, let me know as well, and we can get you collateral to help you share the news of different ways to help a client, achieve their dreams of buying that next house. And we are very easy to introduce. So if you're, running to a client that might need, this strategy or want to talk through things, you can share their information with us, and we're happy to reach out proactively. Obviously, that's the most, successful one normally. Or you can send us a joint email introduction, a joint text introduction. The best contact information, for me is my cell phone, which is 925-789-0065. Here on the slide, you'll see our office phone as well, which we do monitor all the time, and we're always happy to help. I don't see any questions of concern in the chat. Do you, Nikki?
No, I don't see any questions, but I know that everybody knows how to get a hold of us. And you can ask us questions at any time. I think the biggest takeaway, really all you need to know is that you have an expert on your team, right? I mean, this is complicated financial tool. These bridge loans, the Golden Bridge, you guys don't have to memorize this. This is not your job, not your responsibility, but you have an expert on your team. And so helping your clients feel confident in the fact that you are referring them to somebody that you know is going to give them the best tailored solution to their dreams. That's really what we do. We help you get your clients to their dream with a tailored, customized solution. So thank you so much, everybody, for coming. It's so great to see your comments, and it is something the Sullivan Group, this is Casey and I, what we really truly believe in is that we're here to support you. We want to help you be successful. We want to help you close deals. We want to help you get into offers. That is our objective every single second. So let us know how we can improve, how we can do that better, and how we can collaborate to make that happen. So with that, we have, also a reminder, please fill out the survey. Would love to get your feedback so you could put all of that information in there. And please feel free to, we're going to send out this recording afterwards. Please share this with your colleagues. If you hear anybody talking about bridge loans or buying before you selling, you're welcome to share this information. You're welcome to give them our contact information and introduce us to them. So again, we're happy to help your friends, your colleagues, because that's what's important to us. So with that, Casey, it is exactly 12:30. So
perfect.
Like to close our loans early or on time. Best we'll go ahead and close this. But go ahead and fill out the survey. And like Melissa said in the chat, the recording will be sent out in about an hour. So give us a little time to get that out to you. And check your email, because that's where it will be coming.
Thanks, guys. Bye.
Okay, thank you. Have a great day, everyone. Bye-bye.